In this video, I'm going to show you a very simple scalping strategy for the index markets. Now, the two markets which I'll show you examples in this video are the S&P 500 along with the Dow futures. Why these two markets? Well, they're the two markets which gave you a volatility edge. If you're looking to scalp the markets, I think the first and most important thing is making sure you have that volatility edge. It makes everything else easier. Starting off with the better entry helps solve half of the problems associated with trading. You've been able to mitigate your risk to reward and make sure that you're entering in a place where you actually have probabilities on your side. Now, the Nasdaq and the Russell, for example, today did not give you that same sort of edge. I'll share what the details and the nuances of the setup are in this video and why the S&P and the Dow stood out today and what the results of each of those two markets were and how to spot these setups yourself. Now let's get started with the S&P 500, and I'm going to spend a little bit more time detailing the setup here. Now, as part of this scalp setup, there's really just a handful of indicators that you need. The first one is the Scalper Volatility Box models. These are the futures models I have loaded on. We have 5 available. For scalping setups, I'm looking at just the Scalper model. The rest are a little bit more, or require a little bit more risk. The Scalper model requires a little bit less risk, so that's why we're using the Scalper models. The other indicator we're going to need is the edge signals indicator. This helps us confirm when we're officially in overbought or oversold territory, which was the case in today's scenario. The remainder indicators are all optional, and I'm going to remove them just to keep charts nice and clean. So 2 simple indicators, and you'll see how these 2 indicators help you spot when you want to enter. Now, the first thing is knowing when you have that volatility edge. That volatility edge happens when price crosses our Scalper Volatility Box models. So with this red candle right here, when price crosses the cyan line, that's our first clue that, hey, we officially have a volatility edge, and now we're looking at a potential scalp setup. Now here, if price had continued to keep going outside of our Scalper Volatility Box clouds, that would have meant that we're no longer looking at the S&P for any sort of day trading scalp setups. Instead, we're focusing on a little bit more conservative setups. We would switch to the aggressive volatility box models and keep working our way down to adjust to the volatility. Now, in the case of the S&P 500, what ended up happening is we breached our Scalper Volatility Box models, and then price started to stabilize. Now, after this happens, we're looking for our edge signal arrows. That's this green arrow right here. And in the case of the S&P, we saw 1 and we saw 2, and this is on that 1-minute time frame chart. Now, when we see these arrows, that tells us that we're officially now in oversold territory. We're looking for buyers to step in. Once we see this arrow, we're looking for an entry at the cyan entry line or better. So in this little pullback right here, that was the entry point inside of the S&P 500. And you had a decent amount of time to get the entry, about 5-ish or so minutes. So the S&P wasn't a quick touch and go. It gave you plenty of time to actually build your position up. Now, the risk inside of this particular trade is once we get that entry, so we had the edge signal, we got the pullback, the entry's at the cyan line, our risk, no matter where your entry is, even if you get your entry better closer towards the clouds, our stop is outside of the volatility box clouds. So the risk in this particular trade inside of the S&P 500 was about 10.5 points. That same 10.5 points is what we're looking for our first target. So we fell shy in this first leg up, but it's in the second leg up that we actually hit our T1 in this big green candle. Now T1 is the same 10.5 that we risk. So if I were to draw this out here, 10.5 and 10.5, that's our risk and that's our first target. It's a 1-to-1 risk to reward ratio. Now after this green candle, for any remaining contracts to stop, we move from outside of the clouds to break even. This now means that we're trying to make this a trade we can't lose on. What we're going for with the second batch of contracts with that break-even stop for the times we get it, which included today, is a home run sort of trade. That uses this target line on the other side with a $0 risk now with that break-even stop to try and see can we get a little bit greedy. Now in the case of the S&P 500, the move from our cyan line to the actual home run trade was not that much different from our T1 today. It was about 12.25 points compared to the 10.5 points that we had for the first target, still targeted out in that same candle. Now, what becomes interesting is if you zoomed out, and for those of you that like to have runners, you'll see that rally that the S&P had and how this scalp entry, what was meant to be an initial scalp entry, which we first targeted out in our first initial candle, then we had T2 met shortly thereafter in that same 1 minute candle. And after that, we had this run. Now let's repeat everything we just learned and apply it inside of the Dow. Now, same idea inside of the Dow. Price first breaches our sign line. That's step one. And this is again on the scalper volatility box models. We're now looking for these edge signal arrows before price goes outside of our clouds and before price goes and hits what would be our T1, which again, if you remember, is simply just the sign line to the outer edge, what we would risk, which in this case in the Dow is about 75 points on this trade, 76 actually to be exact. Now that 76 is what we were looking for our first target. And you'll see in the case of the Dow here, that first target and that home run trade was actually a little bit less. So our first target was greater than even the target line, a nuance of the scalper model. So T1 was the max that we got inside of the Dow of that plus 76. And that's why I thought it was worth calling out. In either case, inside of the Dow, you had that same move up. It's this initial risk-free, heat-free move that we're looking for as part of our scalp trade, and then anything else starts to really become gravy on top, in which you've already added to a T1 where you now have $0 of risk on the actual trade. So one more time, if we were to recap the setup, and I'm going to come back to the S&P here to do that, what we're looking for is a breach of our sign line. We then want to see at least one of these edge signal arrows. Multiple is nice. Once we see that, an entry at the sign line, our stop is outside of the volatility box clouds. Whatever this risk amount is what we're looking for our first target. And our second target is at this gray target line with the break-even stop. In the case like the Dow, where our second target or this gray target line is less than even that first target, that first target is what I'm aiming for my bare minimum move, at least what I risk. Never will I go for less than a 1-to-1 risk to reward ratio. That just simply doesn't make sense. Now, finally, if we apply this inside of the Nasdaq to see why the Nasdaq was not a valid trade, you'll see the Nasdaq breached its models. We had the edge signal arrow, but we never had that retest of the cyan line. We got close in this pullback here, but we fell a little bit shy, and it's that cyan line that I want to use for the entry because that's what allows me to maintain the risk that I have in this trade and make sure that it's at least a 1-to-1. And when I can then get to a break-even stop, I know that my entry was at a place where I'm okay having that break-even stop. And finally, inside of the Russell, same idea. We breached, we had the edge signal, we never got the pullback to the edge signal, never got the entry where I think we would have the edge, and didn't meet our trade plan rules. So there you have it, the scalp day trading setup, which works fairly well for the index markets. It requires you to follow a very specific set of rules, but as a result of following those rules, you can systematically get yourself into positions in which you have the probability skewed on your side. You have both T1, T2, and places a systematic move for your stops along the way to make sure that you're protecting rewards and also letting the trade run without suffocating it too much. If you'd like to learn more about the setup, the name of this setup is our Fade Setup. I'll leave a link to a video which goes into a little bit more detail around the rules and some more examples on this setup. Take care, everyone. Good luck trading, and I'll see you in our next update.